Guys, today we're looking at 3 stocks that are selling near their 52-week low. Let's analyze them to see if they're selling below their intrinsic value. Stock number 1, a stock that I own, and I'm going to tell you over and over, never buy a stock because I or anybody on the internet owns it. Do your own research. We're here to teach a principle-driven investing philosophy, which I'll get into later. Nike, it is down to $71 per share. This is a company, when it was at 180 back at the end of 21, we were talking about how we weren't interested in it anywhere above 100. And people were like, oh, Nike will never go below 100. You're an idiot, pal. It's not to say I told you so. It's to say that anything can happen. Now, the great news is, like Nike, 52-week low stocks are great stocks to start to look for value. But don't confuse that with a stock being at a 52-week low, selling for a good value. The example I always give is, if I listed my house tomorrow for $10 million, even though it's worth, let's say it's worth $1 million, if I lower it to $5 million, does that make it a good deal? No, it's still only worth $1 million. Here are some metrics on Nike. $100 billion market cap, free cash flow of $5.5 billion, higher than its 5-year average, and people are telling me Nike is dying. Maybe so. 44.5% gross margin with a very consistent 10% margin across the board. Great thing is, their free cash flow in the last 5 years is pretty close to their net income, and last year's free cash flow is about 10% higher than net income. Very high returns on invested capital. What does that mean? This is a business that gets a good return on the money invested in the business. It's a moat type of business. It is a premium company. This company deserves a premium. Let's look at the 8 pillars here before we get into a little bit of the company. Guys, look at this. 8-pillar thriller. Everything is a check mark. This is incredible. This is incredible. Wow, big dividend here. 2.1% on their $5.5 billion free cash flow. So less than 50% and less than 50% of their 5-year average free cash flow. Now, Nike isn't just a company. It absolutely is a juggernaut. It commands, ready for this one, guys, 43.7% of the sportswear market. That is domination. It's obliteration. They did $51.36 billion in 2024 in revenue, and Nike blends innovation and iconic storytelling, which includes signing lifetime deals with LeBron, Kevin Durant, and we all know about the deal with Michael Jordan. And they're going even further to support their future. They're locking in the next generation with names like Caitlin Clark and even a 13-year-old soccer prodigy, McKenna Mack, with them. But here's the kicker. No giant is invincible, and Nike wouldn't be selling for such a low price compared to its all-time high if there wasn't some sort of negative story behind it. They have a heavy reliance on China, which is a key growth driver, and they face a lot of risk from economic slowdowns over there and rising competition from their local brands like Anta. Rising costs and clearing out inventory are also squeezing margins, which is going to test the investors' love for its premium pricing. That is why the price is down so much. But guess what? I've heard more negative stories as of late with this chart. Here, Paul, you're an idiot. It'll never sell below 100. Here, Paul, you're an idiot. Nike is dying. It's probably neither one of these. We've already proven it's not this, being it can't go below 100. Is it dying? Maybe. Companies die all the time. My principle-driven investing is about finding companies to own for 20, 30 years at a time. And if I can buy them for a discount to what their cash flow will give me, because every investment's the present value of all future cash flows, I can do well. If I think Nike will be a bigger company 20 or 30 years from now, or any of these other companies that we're going to talk about, and I can pay a reasonable price for it, I will do well. Now, there are disruptors out there like Lululemon and Hoka, and they're proving that there's space for more than just the swoosh. But great brands need great execution. They can't just rely on little old Paul to buy their products. And Nike's future depends on staying ahead of the game. They don't have Steph Curry. They lost Tiger. There's other things they have to work on, but they're absolutely dominating this direct-to-consumer form of letting people customize their shoes. It's absolutely amazing. Now remember, we don't know what the future holds. Let's see what the analysts think about Nike. They think this dead company is going to grow their earnings from $281 to $636 per share. Massive double-digit growth for the next 4 or 5 years. As for revenue, for this big company, $48 billion, which would be a drop of 7.5%, up to $66 billion here in the next 4 or 5 years. Now, Not a ton of growth, but I think that gross margin and increasing it with more direct sales to consumers will help. Now, we have a story. We have numbers. We got to put them together because numbers by themselves is just an Excel sheet. Story by themselves, it's just a fairy tale. That's what Professor Oswath says. And when he said it, I thought it was a brilliant statement. That's why we use the stock analyzer tool. It allows us to make assumptions about the future using the story, because you're going to take that story and go, okay, if the story for Nike looks good, how do we drive revenue growth? How do we drive profit margin? How do we drive these multiples, etc.? You factor in things like the return on invested capital. This is the reason why in the last year, 4,700 stocks were analyzed by our users in our community. And since we started the software, over 8,500 stocks have been analyzed. Guys, it's incredible. It allows people to put the story and the numbers together to help them make better decisions on investing. So let's pull up Nike when I did it before. Let's see. Now remember, this does not include the balance sheet. And I did a 10-year analysis. I did 3, 5, and 7% revenue growth. I did profit margin of 10, 11, and 12. Same with free cash flow. PE, guys, premium company, high return on capital. It's a moat. If you ask 100 people what's the number one sports apparel brand, how many are going to say Nike? So I put 20, 23, and 26. And again, my 9% desired return, if you're new to the channel, I only put 9 or 10% in there because I want to find what's the intrinsic value. What's the value if this were to match the market? Now remember, don't buy it for that value. You need a margin of safety because the future is unknown and we're humans and we're going to make mistakes. So you need that higher number here in order to account for that margin of safety. The higher your desired return, the lower your price. It gives you that margin of safety. So I hit the analyze button. The stock's currently at 71.20. Guys, I got a low price of 60, high price of 118, middle price of 84. If I paid today's price, I'm looking at 11.5% return, including the dividends. Guys, I know what I'm going to do. I'm going to go sell puts on Nike right now at lower prices. And if you want to learn more about that, you should join our community to learn more about that. Stock number 2, AMD Advanced Micro Devices. Guys, this company hit an all-time high of 227 back just in March of this year. Had a low of 114 back just last week, just 2 days ago, actually. And now it's at 120 per share. Guys, this company is riding this boom. So let's look at some high-level items. Price to free cash flow, 126. Ouch. PE ratio, 107. 5-year price to free cash flow, 98. Guys, their free cash flow in the last year is lower than their 5-year free cash flow, which is very different than a company like NVIDIA. NVIDIA is just crushing it over there. Now, AMD has been like I feel like the David in the David versus Goliath all the time. AMD, AMD, AMD. And they've sold as low as like $1 a share in the last 10 or 15 years. I mean, it's incredible how much this company has persevered and gone through everything. Let's look at their pillars. All right, 4 checks, 4 X's. We see revenue growth. We see net income growth. We see greater cash flow growth in the last 5 years than, oh no, the same amount. Sorry, I thought it was 1.26. Reasonable debt, but these valuations, and guys, look at this. Shares outstanding up 35%. You know what that means? If there were 100 shares before and there's now 135, if you were a shareholder, you now have 35% more shareholders to split the revenue and profit with. That's a tough pill to swallow. I get why AMD did that. They're probably like, hey, our stock's so expensive. Look at 100 times free cash flow, 100 times earnings. Let's give the people what they want. Let's give them the stocks. That way they buy them, we can raise more cash instead of debt. I get it. That's dangerous for people. Now, AMD is out to prove that they're not just a tech contender, but a heavyweight, because they have been, like I said, the David versus Goliath all these times. They fired a direct shot at NVIDIA with their MI325X AI chip, followed by the MI350. To fuel this ambition to compete with NVIDIA, they acquired Finnish AI startup Silo AI for $665 million in 2024, which shows that AMD is willing to bet on specialized expertise to leapfrog into AI dominance. AI is the place to be, and it's the first one to market is probably going to do the best. But the good news is for AMD, it's not just about AI. They have their Zen 5 architecture, which powers the Ryzen 9000 and EPYC 9005 series, pushed their desktop CPU market share to 28.7% in Q3, chipping away at Intel's dominance. Intel's been suffering lately. AM has tried to be picking up the slack from there. They're also stepping into healthcare, investing $20 million into AppSki, leveraging their AI for drug discovery, which is going to be a huge market in the future if I were to guess. Guys, we're all about trying to live longer and healthier lives. Look at things like Ozempic and Wegovy. These things are trying to help people stay thin. Look at the advancements we're making there. We're going to have a major advancements in life quality as time goes on. AI is going to help with that. Now, one big key concern with AMD's business is their heavy reliance on TSMC, which is Taiwan Semiconductor for manufacturing. There's a lot of geopolitical tension, and there could be supply chain disruptions even further in Taiwan that could derail AMD's ability to compete. For investors, that's a wild card. That should factor into your margin of safety. You have to factor it in there. So let's go see what the analysts are saying about AMD's future. Well, they seem pretty optimistic. $5.15 a share here to $10.89 a share in 3 years. Revenue, $32.85 going to $50 billion. That's a lot of growth, guys. A lot of growth. Remember, they're analysts. They have bias, just like you and I do. But it's about understanding where they look at it and see if something's very different from what you think, why they could be different. So again, let's marry the story with the numbers and pull up our stock analyzer tool and see AMD. We have 8, 12, and 16% revenue growth. That's a lot, but a company like AMD could do that. Profit margin. Now you can see right here, the profit margin and the free cash flow has been pretty low. So I'm gonna give them more benefit of the doubt though, that they can get better. I'm gonna put 8, 15, and 22. So the first thing I'm gonna tell you is I'm already making aggressive assumptions here, that my middle assumptions are already higher than they've ever done in the last 10 years. That's something to consider here and factor in when thinking about your margin of safety. PE, I put in 18, 21, and 24. This ROIC is pretty crappy, but they're still growing their business. They're still spending a lot of money to do that. So that could affect the ROIC. Guys, the numbers here I want to be cautious on. I'm still putting in my 9% desired return. I really think this deserves one of the highest desired returns you can come up with. You need that margin of safety because I made quite some assumptions here. But I hit the analyze button. Now, before we check out those prices, you've heard me talk about marrying these things together. You've seen me use these tools. And the reason for that is, guys, I learned really early on that for me to be successful investing, I've got to factor in investing in a way that makes sense to me. What made sense to me is thinking about companies from a long-term perspective. And that's very different out there because right now out there, it's literally minute by minute. But our principle-driven investing is all about sitting there and using our community and tools to make better decisions, to realize that when you buy a stock, you're buying a piece of a business. Every investment's the present value of all your future cash flows. We don't decide if we're right or wrong based on short-term fluctuations of stock prices. We are here to use these tools to make better decisions. So if you've been to our website to sign up, you've probably seen that we have a wait list. Today's software includes everything we have to offer for stocks, real estate, retirement, and economic data. But behind the scenes, those changes are actually happening right now. I've been saying this for a while, but they're actually happening. I built this software originally for myself, selfishly, because I needed to make better decisions with money and I needed my team to make better decisions. On the real estate front, I bought over $30 million in real estate last year and I'm on pace for $50 million this year using this exact tool, the exact tool you will get. You can use it to buy single family homes or a 1,000-unit property. But as we've grown, it's less about me and more about how I can better serve you. And this is why we update our software. And this is why we have several developers on staff full-time. Now, we've already started launching these changes. So if you join today, you'll be grandfathered in for life to get all the tools we offer here, not including the trading, everything else. And you will also be grandfathered into your pricing tier forever. So as long as you join right now, you'll get all of these. So go make the best decisions you can make this year. Start the year off right. It's $1 for 1 day, $7 for 7 days to try it out. Take it for a test spin. I assure you, you'll love it and be part of our community for a long time. Now, hit the analyze button. And what do we got here? We got a low price of 30, high price of 186, middle price of 85. And guys, remember, that 85 is based on numbers they have not achieved. This to me is the too hard pile. You got a low ROIC, you got major dilution, and no sign of it stopping. And I've got assumptions here that are very tough to hit, that they haven't hit, and it's still not even at the price. I'm just apprehensive about it. I think there are better buys out there. I mean, probably one could argue that NVIDIA is probably a better buy, even though it's such a high valuation right now. Stock number 3. Guys, this is the big one. The stock that I have a small position in, but I'm hoping it ends up being a home run, Intel. Now, I got lucky on Intel over the last few years, buying and selling it. But now, I'm definitely in a loss on Intel. But this is a long-term play. I believe that Intel has a great brand. This very laptop I'm using right here for the software is run by Intel. They remain a titan in tech with over 70% of the server CPU market. Essentially, what this means is they own the toll roads for today's data-driven economy. With cloud computing and AI booming, Intel's dominant position ensures steady and robust revenue. Now, here's the kicker. Intel is investing $100 billion in new fabrication, including the Silicon Heartline project just down the road from us in Columbus, Ohio. This bold move specifically targets Taiwan Semiconductor and Samsung, giving Intel control over its supply chain while capitalizing on the surging chip demand. Plus, government support in the amount of $52 billion via the CHIPS Act. This positions Intel as both an innovation leader and a strategic national asset. Now, there's challenges here. There's a lot of competition from AMD, NVIDIA, Taiwan Semiconductor, especially in advanced nodes. Delays or missteps here could threaten any sort of edge remaining for Intel. For investors, execution is everything. And they just recently had their CEO step down, so there's some issues there. Now, the question is the juice worth a squeeze here? You've got a company with a lot of X's here. It's terrible. Absolutely terrible on the pillars. Look at this, what's interesting for analysts. They have profit going from $1 to $4.63 in the next 3 or 4 years. Let's say they're right on this. Times 20 makes the stock worth $92 that you can buy today for 20. So if you believe analysts here, you're looking at over 4.5x your money if they can actually achieve this. Look at their revenue according to analysts. $57 billion, which is down significantly from their all-time high, surpassing their all-time high in 3 or 4 years to $90 billion. Guys, it is all about execution. And this is a situation where it's not one of those staple companies you buy and put a big number in here. What it is a company that if you like the story and you like the potential, you put a little bit of money in, because if you lose it, whatever, that's my opinion. If I lose it, okay, whatever. If I'm right though, it could do very well. Now here's what I'm gonna show you. Here's my stock analyzer with very low assumptions. 0, 2, and 4% revenue growth. Profit margin, 14, 18, and 22. Guys, before 5 years ago, they were consistently 20% plus. PE, 12, 15, 18, and a 9% return. Now guys, after this video, if you wanna watch another 52-week low video, check the next one out, but watch this. Hit the analyze button. Guys, it's selling for its current low price, high price of 51, middle price of 32. This might be worth the squeeze. I don't know. Don't do it unless you feel comfortable, and talk to the people in our community about the stock. I will see you in the community. Thank you for your time.